Good morning, everyone. Welcome back to Global Macro Pulse. It is Wednesday, February 4th, 2026. And if you are looking at your terminal right now, if you're staring at that top left corner where the commodities usually sit, you know exactly why we are here today. You know exactly why the tone of this conversation has to be a little bit different.
It's the number. It's the one everyone said was, impossible. Or at least they said it was impossible for this decade, but, well, here we are.
We aren't talking about basis points today. We're not talking about incremental moves or standard deviation shifts. We are talking about a fundamental breach, a breach in the psychological architecture of the entire market. We just have to look at the scoreboard. Spot gold.
$5,070 as of right now.
$5,070. Just say that out loud for a second. Let it sit in the room. We have breached the $5,000 barrier.
Yeah.
And we didn't just gently tap on the door. We smashed right through it. We are up nearly 2.5% intraday. That is a massive, massive move for an asset class that usually moves in decimals.
And the way it happened is what really matters. I've been staring at the intraday chart, all morning. This wasn't a slow creep. This was not a gradual accumulation where buyers slowly, methodically bid up the price. If you pull up the 4-hour candle, it honestly looks like a heart attack on a screen.
A heart attack, that's a good way to put it.
It's a vertical, just a violent snapback. We saw a dip early in the Asian session, a really sharp V-shape, and then boom, the buyers just stepped in with a ferocity that, frankly, I haven't seen since the onset of the Ukraine war back in 22.
It feels like a verdict. That's the word I keep coming back to in my head.
Right.
$5,000 isn't just a resistance level. It feels like a verdict on the stability, or maybe the lack thereof, of the entire fiat system. It's the market voting with its feet, and it's running. But here is the thing that is really confusing me, and I want you to walk me through this because the data seems to be conflicting. Usually when retail gets this excited about gold, when my uncle calls me asking about coins, or when CNBC runs a special on buying bullion, you see the ETFs just loading the boat. You see the SPDR Gold Trust GLD adding tons and tons of metal.
Right. That's the standard retail FOMO signal. It's the textbook sign that the, let's call it the dumb money, is chasing the price higher.
So that's not what our proprietary data is showing today, is it?
No, and this is the real aha moment for this entire session. If you miss everything else we talk about today, you need to catch this. The SPDR Gold Trust actually liquidated 3.72 tons yesterday.
Wait, say that again?
Holdings are down by almost 4 tons to roughly 1,083 tons. They are selling.
So let me get this completely straight. The price is absolutely ripping to all-time highs, exploding upwards by, $120 in a single session?
Mm-hmm.
But the main vehicle that retail investors and your standard wealth managers use to buy gold is selling.
Exactly. They are selling into the rally. They're taking profits, thinking this is the top.
So who on earth is on the other side of that trade? Who has the kind of capital to absorb nearly 4 tons of institutional selling and still push the price up 2.5%? That's not a small player.
And this brings us right to the Goldman Sachs note that landed on desks this morning. It's a proprietary piece, very dense, but the headline is, well, it's a game changer. They are identifying a massive, and I mean massive, rotation in what they're calling Western flows.
Define that for us, because for the last 3, maybe 4 years, the entire narrative has been China buys, the West sells. It's been a one-way street.
Correct. Since 2022, the gold put has been the People's Bank of China and, the Indian wedding season. They were the buyers of last resort, buying to de-dollarize the reserves. The West, meaning London, New York, Zurich, was largely indifferent or was actively selling to chase tech stocks and these AI bubbles.
Right.
Goldman is saying that as of January 2026, that regime has completely flipped on its head. The buying that is driving this incredible move to $5,070 is coming from Western institutional time zones.
So this isn't retail. This is New York hedge funds, London macro desks, that kind of money.
This is the smart money in the West. And you have to think about why that matters so much. These aren't people buying gold because they like shiny rocks or because it's a cultural wedding gift. They are buying it because they are professional risk managers. Their entire job is to not lose money.
Right.
So if Western institutions are suddenly desperately willing to pay $5,000 an ounce, a price they would have laughed at just a year ago, they aren't doing it for capital appreciation. They're not betting it goes to $6,000. They're doing it for insurance.
That's a key distinction. That is a really key distinction. You don't buy flood insurance because you think the policy's value will go up and you can flip it for a profit.
No.
You buy it because you see the water rising up to your front door.
And the water is definitely rising.
Yeah.
Goldman has moved their formal target up to $5,400 by December. of this year. But they put a huge caveat in there, a really important one. They said there is significant upside risk, meaning $5,400 is their base case, their everything goes okay scenario. The risk case, if things actually break, is much, much higher. They didn't even put a number on it, which is telling.
I want to dig into the mechanics of this Western squeeze. You mentioned earlier that this might not just be physical buying, but a derivative squeeze happening in London. For the listener who doesn't trade futures, what does that actually mean? How does a paper squeeze in London push up the price of physical metal if the ETFs are actively selling?
Okay, so we have to look at the plumbing of the market for a second. The London market is an OTC market over the counter. It's not a centralized exchange. It's basically a network of banks trading unallocated gold with each other. It all runs on credit. Bank A lends gold. It doesn't really have to Bank B.
Paper gold.
Paper gold, exactly. And usually this system works just fine. It's efficient, it's liquid, but when the price moves this fast vertical, as we said, the banks that are short, meaning they owe gold to someone else, they start to panic.
They need to cover their positions. They need to find real metal.
They need to find physical metal to cover those paper positions. And you think, okay, the ETFs are selling, so there's plenty of metal floating around. But the quality and the location of that metal matters immensely. If you are short in London, you need 400-ounce good delivery bars sitting in an accredited London vault.
Right. You can't use a gold coin from a shop in Iowa.
You can't use a coin from Iowa. You can't use jewelry from an Indian bazaar. It has to be that specific type of bar in that specific location.
So we have a liquidity mismatch. The paper market is absolutely massive, but the specific physical bars needed to settle these trades are suddenly very scarce.
We have a scramble, a full-blown scramble, and we are seeing signs of stress in the silver market that totally back this thesis up. Just look at the iShares Silver Trust, SLV. It dumped 108 tons yesterday.
108 tons. That is a massive liquidation.
A huge liquidation. But the price of silver didn't collapse. It held up. And more importantly, the bid-ask spreads in the London silver market are blowing out.
Explain blowing out for the non-trader. What does that feel like?
It means that normally the difference between the buy price and the sell price for silver is tiny. We're talking fractions of a cent. It's an incredibly liquid market. Right now, dealers are widening that gap. They are essentially saying, I don't really want to take your order unless you are willing to pay a massive premium.
So the price you see on the screen isn't the price you can actually get.
Not for any real size. It tells you that liquidity is drying up fast. The market makers, the dealers, they are scared to take a position because they aren't sure they can hedge it or find the other side. They're afraid of getting run over.
It's like when a bookie at a horse race widens the odds dramatically because he has no idea who's going to win the game. He's just terrified of the risk.
Precisely. And Goldman pointed this out specifically in their note. They said, and I'm quoting here, London liquidity conditions are exacerbating volatility. That is a very polite, very banker way of saying the plumbing is getting seriously clogged.
It's a 5-alarm fire.
It's a fire. When you try to push billions of dollars of panicked Western institutional capital through a pipe that has been neglected and shrinking for 3 years, the pressure spikes. And that's how we get to $5,070.
So if I'm a portfolio manager listening to this right now, the takeaway is completely ignore the ETF outflows as a bearish signal. That's just retail and slow money taking profit. The real story is the price action. The price is ignoring the selling. That is the literal definition of a powerful bull market.
It's a bull market that is climbing the proverbial wall of worry. A very big wall.
Okay, so we have established that Western capital is panic buying insurance. The obvious next question is, what are they insuring against? What is the specific catastrophe they see looming on the horizon that justifies paying $5,000 for an ounce of gold?
And to answer that, we have to leave the trading floor in London and New York and go straight to Washington, D.C., because there is, and I don't think this is an exaggeration, a civil war breaking out inside the Federal Reserve.
Let's pivot to segment 2 then, the Fed. We need to talk about this Warsh versus Milan dynamic. And I really want to frame this properly because this isn't just, personnel gossip about who gets a corner office. This is a deep structural conflict in the very philosophy of how money is created and destroyed in America.
I agree. It's probably the most significant divergence in Fed leadership philosophy since the days of Volcker in the 1970s. We usually see a very united, very boring front from the Fed. We are not seeing that right now.
So let's set the stage for everyone. We have breaking reports this morning confirming that Milan, who everyone in the market knows is the big dove, the guy who basically wants cheap money forever, is resigning from his post as the White House Economic Council chair.
which under normal circumstances would be the end of his influence. He'd go off to a think tank, write a book, do a few speeches, and his time in power would be over.
But that's not what's happening here, is it?
No. This is the big twist in the story. He is staying in the Federal Reserve Board. He holds a governor's seat, and those terms are incredibly long. They're set by law. He doesn't have to leave that post. So he is effectively bunkering down inside the Fed itself to fight a guerrilla war against the new leadership.
And at the exact same time, we had the incoming nominee for Fed chair, Kevin Warsh. Now, Warsh is a known quantity. He was a governor back during the '08 crisis. He is not a dove.
He is the anti-Milan. He's the Hawks hawk. Warsh has been giving speeches lately, signaling what he calls a return to sound money. But the market is calling it something else. They're calling it a hawkish storm.
Because he doesn't just want to hold rates high. He wants to do something much more dangerous. He wants to aggressively shrink the balance sheet.
And we need to pause right here and really explain what shrinking the balance sheet or quantitative tightening QT actually means. Because to a normal person, that sounds incredibly boring and technical. Oh, the Fed is selling some bonds. Who cares? But Mizuho Securities just issued a warning note this morning calling this plan a potential cognitive black hole for markets. That sounds terrifying.
It is terrifying if you understand the plumbing. Think of the Fed's balance sheet as the water in a giant swimming pool. The banks are all the swimmers in that pool. The water represents the reserves, the raw cash that banks hold at the Fed to settle payments with each other every day.
Okay, so plenty of water in the pool. Everyone can swim safely, no problem.
Since 2020, that pool has been overflowing. It's been like an infinity pool. Just tons of water. Everyone is happy. Warsh wants to drain that pool. He looks at it and thinks there's way too much water, and it's causing inflation to splash out everywhere. He wants to sell the Fed's assets, their treasuries and mortgage-backed securities. When the Fed sells a bond, it literally takes cash out of the system.
He's pulling the plug on the main drain.
Exactly. But Mizuho's core argument is that the pool is much, much shallower than Warsh thinks it is. There are other hidden drains that have been sucking out water already, things like the reverse repo facility and the Treasury's general account. If Warsh starts an aggressive QT program, he might drain the water level below the safety line before he even realizes it.
And when the water level gets too low in the pool,
the swimmers start hitting the concrete at the bottom. That's the repo crisis. Banks suddenly realize they don't have enough cash to settle their overnight trades with each other. The interest rates in that crucial overnight market spike to 10%, 20%, even higher. The gears of the entire financial system grind to a halt.
We saw a preview of this back in September 2019. It wasn't pretty, and the Fed had to intervene with emergency liquidity. But the system is so much more leveraged now, so much more complex than it was even back in 2019.
Infinitely more. And that is why this Milan factor is so fascinating and so dangerous. You're going to have Milan, a sitting governor, openly voting against Warsh's plans. Are you going to see 5-4 votes, 6-3 votes at the FOMC? The Fed is supposed to be a monolith. It's supposed to speak with one calm, unified voice to soothe the markets.
Instead, we are entering what the strategists on the street are calling the open box era for the Fed. You open the box, you have no idea what's going to be inside. Is it a rate cut championed by Milan? Is it a balance sheet rug pull from Warsh?
If markets can handle bad news, they can price it in. They absolutely cannot handle confused news. They hate uncertainty. If the Fed chair says tighten and a powerful governor says loose, the algorithm doesn't know what to do. The risk models just break.
And when the algorithm gets confused, what does it do by default?
It sells risk. It sells the dollar.
Yeah.
And it buys gold.
This explains the really bizarre action we've seen in the dollar index, the DXY. We had that breakout recently, but a lot of analysts are calling it irrational. If the U.S. economy is clearly slowing down and the Fed is about to potentially engage in a massive policy error, specifically a liquidity error, the dollar shouldn't be strong.
It should be incredibly volatile, and that's exactly what we are seeing. The volatility in the 2-year Treasury yield, which is the part of the bond market that tracks Fed expectations, is completely off the charts. It's whipping around like a penny stock on a daily basis. That is not a sign of a healthy global reserve currency.
So let's connect this all back to that Western institutional buyer we were talking about in the first segment. The guy running a macro fund in London or Connecticut, he sees Warsh coming in with a giant vacuum cleaner to suck all the liquidity out of the system. He sees Milan digging trenches inside the Eccles building to stop him. He sees the very real potential for a repo market accident.
He looks at his portfolio, which is the standard 60% stocks and 40% bonds. And he has this horrifying realization, wait a minute, if Warsh breaks the bond market, My bonds don't hedge my stocks anymore. Both go down together.
The correlation goes to 1.
Exactly. In a true liquidity crisis, everything correlates to 1. Every asset gets sold. Except gold. Gold has no counterparty risk. It is nobody's liability. So he buys gold not to get rich, but to make sure he survives the coming Warsh tantrum.
It's the ultimate I don't trust the pilot trade.
And the pilot is actively fighting with the co-pilot in the cockpit.
A terrifying image. But the Fed isn't the only source of instability today, not by a long shot. We have to pivot to the geopolitical map because there are at least 2 major flashpoints flaring up right now that are feeding directly into this market anxiety. And frankly, one of them is getting almost zero coverage in the mainstream press.
You're talking about the Baltic situation.
The Baltic ship seizure.
Yeah.
But before we get to the frozen north, we have to deal with the simmering heat in the Middle East. Let's talk about Oman.
The focus has shifted. It's now confirmed that the nuclear negotiations with Iran are being moved to Oman. The U.S. has officially agreed to this venue change.
Now, historically, Oman is kind of the Switzerland of the Middle East, right? It's where you go when you really need to get a deal done quietly. It's seen as neutral ground.
It is. But the context surrounding these talks is anything but quiet. It's deafening. The friction leading up to this meeting is actually increasing, not decreasing. We're seeing what we call negotiating through escalation.
Can you explain that strategy for our listeners?
It's a classic, if very risky, diplomatic tactic, especially in that part of the world. Before you sit down at the table, you metaphorically punch the other guy in the face to show him you're strong. You try to improve your leverage. So Iran might activate some of its proxies in the region. The U.S. might move an aircraft carrier or tighten a specific set of sanctions. You deliberately create a crisis so that you can then be seen to solve it at the negotiating table.
But that's a really dangerous game.
It's incredibly dangerous because sometimes the punch lands a little too hard or it's misinterpreted, and the energy markets are definitely starting to get nervous about this. The Dutch bank ING put out a note this morning asking a very simple but very important question. How much risk premium is actually priced into crude oil right now?
And what's their verdict on that?
Not nearly enough. Oil has been relatively calm lately, and it's been lulling people into a false sense of security. But ING is basically warning that if these talks in Oman fail, or worse, if they are sabotaged by a hardline faction before they even start, the supply chain risk comes roaring back immediately.
And if you get a kinetic event in the Strait of Hormuz, oil doesn't just go up by $2, it goes up by $20 overnight.
Exactly. And that feeds right back into the global inflation loop that we were just discussing with the Fed. It puts them in an impossible position.
Now, let's go north, way north, the Baltic Sea. This story is just bizarre, but the implications are incredibly serious. A Bahamian-flagged container ship was just seized by the Estonian military.
And here is the real kicker. The entire crew, all 23 sailors on board, are Russian nationals.
Now, Estonia is a NATO country. Russia is. Well, it's Russia. Seizing a commercial vessel is a really big deal. The official line from Tallinn, from the Estonian government, is that this is about smuggling. They are trying very hard to say it's not about sanctions, it's not about the shadow fleet of Russian oil tankers. They claim it's just good old-fashioned criminal smuggling. But do we really buy that?
In this geopolitical climate, it's almost impossible to buy that as a coincidence. You don't just happen to seize a ship with an all-Russian crew in the middle of the Baltic Sea for minor customs violations, unless you were trying to send a very pointed message. The ship was apparently on its way to St. Petersburg.
Feels like a poke in the eye. Deliberate poke.
It is. And you have to remember, the Baltic Sea is basically a NATO lake now that Sweden and Finland have joined the alliance. But Russia still has its enclave in Kaliningrad. They have their entire Baltic fleet based in St. Petersburg. They view the Baltic as a vital national interest. If they perceive this seizure as a coordinated NATO provocation, the response is not going to be a diplomatic note. It will be asymmetric.
And the market impact of that.
It's all about re-rating the risk premium on European assets. If shipping in the Baltic suddenly becomes at risk, maritime insurance rates are going to spike. And not just for Russian ships, for everyone. If Lloyd's of London decides the Baltic Sea is a war risk zone, the cost of moving goods to Germany, to Poland, to Sweden goes up overnight.
Which is, again, inflationary for Europe.
And deflationary for their economic growth. It's a classic stagflationary shock. And markets are terrible at pricing 2 major geopolitical crises at the same time. They can handle the Middle East. They can handle the Baltic. They cannot handle both firing off on the same Wednesday.
And that leads right back to the flight to safety we've been talking about. It's not just gold. We are seeing these weird rotations in the equity markets too. But I want to talk about how governments are responding to this new era of fragmentation. Because while the markets are panicking, Australia just dropped an absolute bombshell of a policy that completely changes the rules of the game for a key sector.
This is, in my opinion, the single most significant structural shift of the day. Forget the price moves for a second, just look at the policy itself. Australia is effectively declaring the end of the free market for critical minerals.
They are weighing a price floor for rare earths and other strategic metals. Let's really unpack what that means. For 40 years, the entire Western world preached the gospel of free markets. If China can produce dysprosium cheaper than Australia can, well, then China wins and Australia loses. That was the rule.
And Australia just took that rule book and lit it on fire. This is industrial policy on steroids. Madeleine King, the resources minister, basically came out and said, we cannot afford to let these strategic mines close. Because in the past, that's exactly what happened. A company like Lynas would spend billions to build a mine. China would then flood the market and drop the price by 40% just to kill them. Lynas would lose money and investors would flee.
It was predatory pricing, plain and simple.
Exactly. By setting a price floor, the Australian government is effectively acting as the buyer of last resort. They are saying to the miners, if the global market price drops below X, don't worry. We will either make up the difference or we will buy your output for our new strategic reserve.
It's a put option provided by the Australian taxpayer.
That's exactly what it is. It is a government-funded sovereign put option for Australian mining companies. And the equity market in Sydney absolutely loved this news. I mean, just look at the tickers today. Lynas Rare Earths, the biggest non-Chinese player in the world, popped 6.9% almost immediately. Iluka Resources was up 5.2%. Arafura, another smaller player, up 6.3%.
And look at Sunrise Energy, a smaller, higher beta player. It exploded 10% higher. Why did it move more than the others?
Beta. They're riskier. Their single biggest business risk was a complete price crash orchestrated by a competitor. The government just stepped in and completely removed that risk from the equation, so the valuation of the company automatically jumps. If you're a stock analyst valuing these companies, you usually have to factor in a bear case where rare earth prices collapse. Now, you can just delete that entire bear case from your Excel model.
That is a massive permanent re-rating. And this isn't happening in a vacuum, is it? This seems to be coordinated with the U.S. We're hearing about a strategic reserve being built. It's about 1.2 billion Aussie dollars, so what, $843 million USD. They're going to be stockpiling antimony, gallium, and of course, rare earths.
It's the NATO of metals. That's really what this is. It's an economic alliance designed to ring-fence critical supply chains away from geopolitical rivals. The U.S. provides some of the money and the security guarantee, and Australia provides the dirt.
So if you're an investor, the actionable insight here seems pretty clear. You have to look at the ex-China miners. The companies in Australia, in Canada, maybe Brazil, they effectively have a state put option underneath them now that makes them much safer, much more bankable investments than they were just 24 hours ago.
But there is a flip side to this. There's always a consequence.
Which is?
Cost. A price floor means prices can't go down. It means the inputs for your electric vehicles, for your wind turbines, for your iPhones, for your F-35 fighter jets are going to be permanently higher than they would be in a free market.
We are explicitly trading efficiency for security.
Exactly. And security costs money. A price floor is inflationary. A strategic reserve is inflationary. So when you look at gold at $5,070, it's not just sniffing out future money pushing from the Fed, it's sniffing out this new structural embedded inflation in the very things we need to build the modern world. You simply cannot have cheap EVs if the raw materials have a government-mandated minimum price.
Speaking of building the modern world, let's pivot to the tech sector, because while the resource miners are absolutely partying in Sydney, the tech giants are having a very, very weird week. And it starts with Elon Musk, who is back in China.
Yes, the rumors are now confirmed. Musk's team is on the ground in China, and they're visiting the big solar giants. Specifically, they were spotted at the headquarters of Jinko Solar.
Now, that's interesting. Musk has his own solar business in the U.S., Solar City, and the Gigafactory in Buffalo. Why is he touring Chinese factories?
He's looking for the next technological leap in efficiency. This isn't just a courtesy call to drink tea. Our sources say they're looking at the production lines for HJT, that's heterojunction technology, and the even more advanced perovskite cells.
Oh, okay. Break that down for us. Why perovskite? What's the big deal?
The standard silicon solar panels, the blue and black ones you see on everyone's roofs, are hitting their theoretical efficiency limit. Physics just won't let them get much better. They can only convert about 22–23% of the sunlight that hits them into usable power. That's it. Perovskite is a new type of crystal material structure that can be layered on top of silicon to boost that efficiency dramatically. We're talking towards 30% or even higher.
And if Musk is really serious about the massive energy needs for AI, for the data centers, for charging the Optimus robot fleets, he needs absolutely insane amounts of power.
And he needs it cheap. And he needs it in a small physical footprint. HJT and perovskite deliver that. China absolutely dominates this supply chain. So even with all the geopolitical tension we just discussed, Musk is, at his core, a pragmatist. If Jinko has the best tech in the world, he's going to go see it for himself.
And it seems the love affair is mutual. Duan Yongping, the legendary investor, often called the Buffett of China, just tweeted out a massive endorsement. He said Tesla's full self-driving, or FSD, is his top choice, and that the new Model Y drives perfectly.
When Duan speaks, Asian capital listens very carefully. It signals a thaw, or at least a kind of separate peace, for Tesla in the Chinese market. It's like Musk is carving out his own independent diplomatic channel, separate from Washington.
But while Tesla seems to be finding its footing again, the rest of the AI sector is having a full-blown panic attack. We saw that flash crash yesterday. What was it? $285 billion in market cap wiped out in a single day across software and finance stocks. And the trigger was a new tool released by Anthropic.
This is the Claude moment. Anthropic released a tool that can automate incredibly complex coding and financial analysis tasks. And the market suddenly looked at all the SaaS companies, the software as a service companies that charge $50 a month per user, and said, wait a minute, if AI can now do this for free or for pennies on the dollar, your entire... It is deeply deflationary for software profits. If AI completely destroys the barrier to entry for coding and analysis, then margins are going to collapse across that whole industry.
But look at the divergence here. The software stocks crashed, but the hardware spending isn't stopping for a second. We have new rumors that NVIDIA is about to drop $20 billion into OpenAI's new funding round.
Think about the bizarre circularity of that economy. NVIDIA sells its expensive GPUs to OpenAI. OpenAI uses those chips to build its models. OpenAI then needs more money to buy more chips. So NVIDIA invests in the funding round. It's a vendor financing its own customer just to keep the demand cycle alive. It feels very frothy.
It feels like a bubble that is actively reinforcing itself. But investors in Asia seem to be voting with their feet. I really want to look at the Hong Kong market because the Hang Seng today tells a very different and important story. The tech stocks were absolutely dead. Tencent was down 3%. Those mini-max concept stocks were down 7%. But look at what was up.
Coal, airlines, high dividend assets. Yankuang Energy was up 8%. China Eastern Airlines was up 7%.
Why coal? In the age of AI, why are people buying coal?
Because it's real. Because it generates cash flow today. It pays a dividend today. The money flowing through Hong Kong is getting scared of the AI valuation bubble. They are looking at these price-to-earnings ratios of 60, 70, 80 and saying, no thanks, I'll pass.
Yeah.
They are moving into tangible assets like coal, something you can touch. They're moving into travel and activity that people are actually doing right now. It is a flight to reality.
So we have a flight to reality in equities, with coal over AI. We have a flight to safety in hard assets, with gold over fiat currencies, and a flight to security in supply chains with these new Australian price floors. The theme is incredibly consistent across every asset class. The world is getting harder, more tangible, and a lot more expensive.
And nowhere is the raw pain of this transition more evident than in the currency markets. We absolutely have to talk about South Korea. The Korean won, the KRW, is in serious trouble.
It's ugly. The won is down 7% since the middle of last year, 2025. And today, we learned that the National Pension Service, the NPS, one of the biggest pension funds on the entire planet, is planning to issue its own foreign currency debt.
This is a desperate move. Let's be very clear about what this is. The NPS manages the retirement savings of the entire Korean population. Usually, they invest in stocks and bonds to grow that giant pot of money. Now, they are planning to go into debt in dollars, just so they can supply those dollars to the Korean market to try and prop up the value of the won.
They're being forced to act like a central bank, not a pension fund.
They are burning the furniture to heat the house. It's the only analogy that fits. They are leveraging up the nation's pension fund to try and save the currency from collapsing. That is a sign of extreme systemic stress.
And it complicates everything for them. South Korea pledged $350 billion in direct investment to the U.S. They promised to build chip factories in Arizona and battery plants in Georgia. But if their home currency is collapsing, that $350 billion becomes exponentially more expensive for them to finance. The capital outflow is killing them. It's a direct consequence of the strong dollar and the Fed's high interest rates.
And just across the Yellow Sea, the Chinese yuan is feeling the heat too. The offshore yuan C&H liquidity is tightening up rapidly.
Yeah.
The overnight HIBOR rate in Hong Kong, which is the cost to borrow yuan, just dropped to 1.27%, a one-month low.
Now, that sounds counterintuitive. Low rates usually mean there's plenty of cash sloshing around.
In this specific case, it means there's no demand. Nobody wants to borrow yuan to short it because the central bank is making it too painful and too dangerous. But at the same time, we are seeing clear signs of capital controls tightening. WeChat just blocked all links to a platform called Yuanbao, which looks like a crypto or competitor payment platform. The walls are going up.
It's the same story everywhere you look. Walls are going up, capital controls are tightening, price floors are being implemented, tariffs are back. The globalized, free-flowing, efficient market of the 2000s is completely gone. We are in a fragmented, jagged, and much more dangerous world.
And in a fragmented world, you don't trust the other guy's currency. You trust gold. You trust critical minerals that are in the ground in a friendly country. You trust energy. And that is why we're seeing this historic price action today.
So let's try to bring this all together for the listener. We've covered a lot of ground in a short amount of time. Gold at $5,070. A civil war at the Fed between Warsh and Milan. Geopolitical sparks flying in the Baltic and Oman. The Australians building a resource wall. Tech completely diverging. What is the grand synthesis here?
The synthesis is that the risk-free rate isn't risk-free anymore. If the Federal Reserve might accidentally break the Treasury market, and if the U.S. dollar is unintentionally wrecking allied economies like South Korea, then the core of the system is fragile. The move into gold is not speculation, it's a rational response. The move into Australian miners is rational. It's a global portfolio shift away from optimism and towards protection.
And my final thought for the day is this. Watch that price floor concept in Australia very, very closely. If that policy works, if Australia successfully protects its miners from Chinese pricing pressure, you should expect other countries to copy that playbook. Expect a price floor for U.S. steel. Expect a price floor for European chemicals. If that happens, the entire structure of global commodity pricing changes forever. We will be entering an era of administered prices, not market-discovered prices.
This means volatility is not a bug, it's a feature. It is here to stay.
Absolutely. Stay liquid. Watch these resistance levels closely. And keep your eyes on the plumbing of the system, not just the headlines.
And remember, none of this constitutes financial advice.
Yeah.
Please do your own due diligence. This has been Global Macro Pulse. We'll see you tomorrow.